Hello and welcome to the lecture for part one of chapter 13. Before I dive into the content for this chapter, I just want to take a minute to let you know that I miss all of you and miss seeing you every week in class. And I welcome your calls or your emails. Please feel free to call me on my cell phone, which I've published in an email to you guys. So please feel free to call me anytime at all. I'd welcome hearing from you. And I hope you're all doing okay, both from a health standpoint and from a mental health standpoint, that you're weathering this strange time okay. So anyways, I'm thinking about you. So jumping into chapter 13, this chapter deals with property, plant, and equipment, and then the related income statement accounts of depreciation and depletion, and amortization, I guess I would include as well. So this is an important category in that for many companies, manufacturing companies in particular, this could represent 50% or more of their assets. So it's a big chunk of their balance sheet. And that's why it takes some time and care from an auditing perspective. But the nature of it's a little bit different than inventory and receivables, which we talked about earlier. So today I'm going to talk about the nature of property, plant, and equipment. I'll talk about what the objectives are, talk a little bit about fundamental controls, understanding the client, and I'll get into a little bit of audit procedures, and then we'll pick up again on Monday for the second half of the chapter. So the biggest concern that we have in this area is existence. So do the assets they're claiming they have actually physically exist? And in many cases, that's going to require putting our eyes on them. When I was involved in a company that had multiple locations, the auditors I would usually fly with them to each of the locations and then take them on a tour and point out new assets. So that's part of it. And then also rights to those assets to make sure they're not really leased or rented, that they are actually owned. So first, equipment, and this is a refresher from Accounting 201 and 301. So property, plant, equipment, those are tangible assets we're talking about now, things you can touch and feel, that have a service life of more than 1 year. So things that are consumed in less than a year, of course, wouldn't be a tangible asset, like supplies and inventory, that are used in the operation of the business. So anything that's not used in the operation of the business, like say we have a specialized machine and we have a second one as a backup that's not being used, that's an investment, not a tangible asset. It's not depreciated. That's an important distinction. So assets that are used in the operation of the business and are not acquired for the purpose of resale. Of course, any assets that are acquired for the purpose of resale would be inventory. So there are three major subgroups of property, plant, and equipment. The first category is land. All of you are aware that we separate that out because we don't depreciate land. It doesn't wear out. The next category is the biggest usually. It's buildings, machinery, equipment, which would be computer equipment, vehicles, all of those kinds of things. And then land improvements. You might remember that from intermediate accounting. So the land itself, and any changes we make to the land, flattening it or leveling it, those kinds of things would not be depreciated. But then things that we add to the land, like fencing or driveways or roads, those things would be depreciated as land improvements. Then the third category are natural resources, which of course don't exist in a lot of companies, but for those companies that do, we'll cover that topic when we talk about depletion. Another word for natural resources is wasting resources, things that get used up over time as we harvest them. So the audit objectives for property, plant, and equipment, one is to get an understanding of the client. What kinds of things do they own? What's important to their business? What is important from an asset standpoint for businesses in that industry? I had a friend that owned an internet service provider business, and how many servers they maintained was very critical in the value of their business. So in some industries, things can be more important than in other industries. We want to understand the internal control that they have over this category. These purchases can be big ticket items, so it's really important that there are good internal controls, kind of for different reasons than we talked about for inventory and receivables. As always, we want to assess the risk of material misstatement based on what we learned in 1 or 2. So we want to substantiate the existence of property, plant, and equipment, so making sure that what they say they own really does exist in reality. Make sure that it is completed, meaning that, well, I jumped ahead a slide, I apologize, screwed up on my own notes here. Making sure that retired assets have been removed properly. That's pretty straightforward when you sell an asset, but if somebody in the warehouse just takes an asset to the dump and gets rid of it because it's dead, the word may not have gotten to the accounting department to remove that from the books. The same thing can be said with regard to trade-ins. If they traded in an asset on a new asset, you may not have taken the traded-in asset off the books. So that's important. So that speaks to existence. Completeness would be, have they bought anything that isn't recorded? That's not as likely. We want to make sure the cutoff is observed. That's not quite as critical because the net income implications would just be a fraction of depreciation expense. So whether they record a December 30th asset or a January 2nd asset isn't super critical like it is for other things. Then make sure the client has the rights to the recorded property. So do they own it? And that's very important because if they don't own it, then it could potentially be leased or rented property. Want to make sure that it's been valued properly. That gets into depreciation, which I'll talk more about on Monday. And then presentation and disclosure. So are they breaking it out by categories? Do they show it net of accumulated depreciation? All of that. Do they disclose their depreciation methods? All of that. I thought this graphic was really beneficial to kind of distinguish between how we deal with current assets versus long-term assets. So current assets, we're really concerned with auditing the balance and the transactions that create that balance. With lower turnover accounts like long-term assets, we're more concerned about auditing the change from beginning to end. So what was added or what was taken away will be our focus. So some controls for property, plant, and equipment that are very important. One is that they have a plant and equipment capital budget. So there's a formal process for people in the company to say, I need a new forklift, I need a new delivery truck, I need a new machine, that sort of thing. And in well-run companies, they have a process for justifying those proposed purchases based on internal rate of return, net present value. A more crude measure would be payback period. I worked for a company that wouldn't approve anything that had a payback period of less than 2 years, as an example. So somebody has done the math to say, what kind of benefits will this asset bring to the company, and how does that justify the purchase of it? And then having a budget for that. That way we can, as auditors, can look at what did they actually acquire versus their capital budget. And that might help point out if there's anything unusual. Companies that have a large number of physical assets often maintain a subsidiary ledger. Just like an accounts receivable or accounts payable ledger, say in the case of payables, it's going to describe the detail behind supporting how much we owe each supplier. Well, a subsidiary ledger for fixed assets might have different categories like computers and trucks and cars and machinery and rolling stock like forklifts inside the building. And within each of those subsidiary ledgers, I would break down each computer I own by serial number, each vehicle by VIN number, and keep track of that detail. And then, of course, anytime you have a subsidiary ledger, you want to make sure that's reconciled to the control account. Next, we want to make sure there's a system of authorization so people can't just go out willy-nilly and buy things, that somebody at an appropriate level has to approve that purchase. And that there is a process for analyzing variances from budget. So and again, that's a matter of interviewing the client, asking what their procedures are for those kind of tracking those variances. I want to make sure that the company has a statement or a policy rather between when expenditure is capital versus a revenue expenditure. So When do we capitalize a repair expense and when do we expense it? So that's the important there. A lot of companies have a dollar cutoff. In my company, it used to be $500. In a lot of companies, it's a higher level than that. We want to make sure that anytime we buy plant and equipment, that it's done the same way we buy normal inventory purchases. So there's a purchasing agent that gets competitive bids, it's received and inspected, a voucher is created that goes to accounting. So the same exact process should be followed. We want to make sure that the client has periodic physical inventories. This is more important in some businesses than others. For example, if you had a lot of computers, to say laptops that could get up and walk away, then it's important to have more important to have a physical inventory, or a lot of cars, that sort of thing. Bolted down machinery might not require as much in the way of physical inventories. And then there is a formal system for authorizing the retirement of an asset and then documenting that so it gets accounted for appropriately and doesn't create an opportunity for shenanigans like retiring an asset and selling it and pocketing the money. So the documentation for this category, of course, we would have working papers that support all of the figures that we accumulate in our different worksheets. We'll have a summary analysis that emphasizes changes during the year. That would be beginning plus additions minus retirements would equal ending. So I'll show you an example of that in a minute here. And then we want to make sure we analyze repair and maintenance expense accounts. What we're looking for here is any large amounts that maybe should have been capitalized. As kind of an aside, if any of you ever work as a controller in a company and year end comes and management is worried that the profit isn't as high as it should be, that's the first place to look. Because often if you go through the detail of repair and maintenance accounts, bookkeepers will take a bill from a repair company and code it to repair and maintenance automatically, and oftentimes miss the fact that maybe it should have been either increase the value of the asset because it adds functionality, or decrease the accumulated depreciation because it lengthens the life. So that's important to look at, both as an auditor and as an insider. And then we would test depreciation, meaning we would go back through and do the math and make sure there aren't any mistakes in that regard. So here's an example of a summary of property, plant, and equipment where they're showing the beginning balance, and then we have additions and retirements and an ending balance for both the asset and accumulated depreciation. And you can see by the ticks and footnotes and so forth that they're tying that out to actual copies of invoices and evidence of that. So audit procedures. So one, we want to use the understanding of the client and its environment to consider all kinds of risks, including fraud risks. We want to get an understanding of their internal control, and then we want to look at those two things to consider what kind of risk of material misstatement there would be, and that will then inform what our audit procedures should be. The first step is to test the controls that exist. So one is to document what the controls are that they have in place, and then look for evidence that those are either being complied with, that they've been implemented properly, or have not been complied with. Then we get into further audit procedures, so substantive procedures. This is, again, like in most other chapters, kind of the meat and potato of things. So first, obtaining a summary analysis, we talked about that, reconciling that to the general ledger. So we want to vouch any additions to property, plant, and equipment during the year. One thing I would comment here, if this is the first year we're auditing a company, we either need to rely on the previous auditor's work on the beginning balances, or we need to audit those ourselves if it's the first time the client's being audited. So that could be a bit more work. For normal audits, we would just look at the additions. By vouching them, I mean looking at the invoices from the suppliers of that equipment, or looking at transactions that relate for company produced equipment. In my company, we used to build some of our own machinery as an example. So I had copies of invoices for different parts and then labor costs for building the machine and factory overhead. So we'd make a physical inspection. I talked about that. That might involve some travel to go look at different pieces of machinery and verify that they're actually there, putting your eyes on it. We'd analyze the repair and maintenance expense accounts, like I mentioned before, document that analysis. We'd investigate the status of anything that's not in use, and sometimes that may be based on visible evidence. We see a machine out behind the building or that sort of thing, or under a tarp, and we can ask about that and make sure that the equipment, if that's the case, isn't being depreciated and is recorded as an investment rather than a fixed asset. We test the client's provision for depreciation. We'd investigate potential impairments. So is the equipment damaged or obsolete? In which case it should be written down. We'd investigate retirements that were made during the year. So were they properly authorized? Were they accounted for correctly? We would examine evidence of legal ownership, like looking at the titles to vehicles, looking at deeds to buildings, looking at actual invoices from suppliers to make sure the equipment was paid for, all of that. We would review rental revenue from equipment or buildings that we own that we lease out to others. That's evidence of ownership. And we would examine lease agreements on property, plant, and equipment leased to and from others to determine the leases are properly accounted for. And remember the new accounting standard where you have an asset that's the right to use the item, and then a corresponding liability that records the net present value of the debt over the course of the lease. Lastly, we'll perform analytical procedures. So that might be looking at repair maintenance expense year over year, or compared to budget, or compared to industry benchmarks to see if their spending is in line with what it should be. Again, looking for something that is maybe too low that shows that they have capitalized things they shouldn't have, or too high, the opposite. Compare acquisitions and retirements, that pace of activity compared to prior years or competitors if possible. That could again point out some maybe areas where things have deviated. And then lastly, we'd evaluate presentation and disclosure and then the related revenue and expenses associated with that to make sure that's in line. So that brings to a conclusion the first part of the lecture for Chapter 13. I'll post a lecture for the second part on Monday morning. Thank you.